What if I told you the money you think banks lend was never there to begin with? Not in vaults, not in safes, not in other people's savings, created the moment you borrowed it. Most people believe this. Banks take deposits and lend that money to borrowers. It sounds logical, comforting, safe, but it's not how modern banking works, not even close. When you take a loan from a bank, the bank does not give you existing money. It creates new money out of nothing, not printed first, not transferred from someone else, created to you with a keystroke. Here's how it really works. You walk into a bank, you apply for a loan, the bank approves it. At that moment, the bank does not lose money. Your account balance goes up, a new deposit appears, money is born. The bank records two things: an asset, your loan, and a liability, your deposit, both created at the same time. No vault opened, no pile of cash moved, just numbers. This is called credit creation. And it is how most money in the modern economy exists, not coins, not notes, but bank credit. This is why banks are so powerful. They are not just intermediaries, they are money creators, private institutions with the authority to expand the money supply. Now here's the part most people miss. When banks create money, they also create debt. Every dollar created comes with interest attached, which means something critical. The money exists, but the interest does not. So where does the interest come from? From more loans, more credit, more debt. The system requires constant expansion. If lending slows, the economy slows. If lending stops, the system freezes. This is why economic growth is not optional. It is mandatory. Without new loans, there isn't enough money to pay back old ones. Now imagine something dangerous. Imagine everyone tried to pay off their debts at the same time. Loans disappear, money disappears, businesses lose customers, jobs vanish, the economy contracts fast. This is why debt is never eliminated. It is managed, extended, refinanced, rolled forward again and again. Banks don't need to control governments directly. They don't need armies. They control the flow of credit, and credit controls everything: housing, business, consumption, growth. When credit is cheap, the economy feels strong. When credit tightens, everything slows, not because people stopped working, but because money stopped being created. This is why financial crises look sudden, but they are never sudden. They are credit events, moments when money creation reverses. So who really controls the economy? Not voters, not politicians. Those who control credit control outcomes. Banks don't create wealth, they create purchasing power, and that power shapes the world. The real question is not, why is there so much debt? The real question is, who decides when new money is created? Because whoever controls that decision controls the system. And that is a story most people are never taught.